All right, Craig. So we've talked a little bit about the benefits of VA loan, who's eligible, and the entitlement that we have. Now let's talk a little bit about actually qualifying for the VA loan.
Sure.
So I decided I'm ready to buy a house. I know I'm eligible. I know I have an entitlement because I haven't used it or it's been restored.
Mhm.
Now I want to actually qualify for a loan. What is that? What's involved?
Yeah. So underwriters are basically going to look at a few areas that are really the same as what they're going to be with most loans. And that's typically going to be your credit, your assets, because even if you're not going to have a down payment, you're typically going to have to cover some or all of the closing costs. And there's certain rules and requirements for those. And then also on like debt ratios. So credit, for example, the VA doesn't actually set any minimum credit scores, but lenders do. Typically, you have to have a 620 or above in order to qualify for a VA loan. Some lenders will go down to 580. You have to kind of dig a little bit deeper to find one of those, but 620 is kind of the benchmark. So going back to qualifying, if you don't if you know what your credit scores are and you don't have that, that may be one of the first things that you actually want to work towards is improving your credit score.
Okay. Now we can talk in more depth about credit scores in a little bit, but in general, the higher your score, the lower your interest rate up to a point.
Correct.
And then the lower your score, the higher your interest rate because it's based on the risk, right?
That's exactly right. Pretty much across the board, when you have a higher credit score, you get more favorable terms.
Yeah, that makes sense to me. Okay, so let's say I have a good enough credit score to qualify for a VA loan.
Mhm.
And now let's talk about assets, right? So
Mhm.
you said I might have to pay a little bit of the closing costs or all the closing costs. So the bank's going to say, okay, do you have enough money to not only pay those closing costs, but do you have a little extra because there's going to be other costs associated with moving in?
Mhm.
What kind of assets do I need to have on hand if I'm going to be buying a house with a VA loan or really any home?
Right. It's interesting. This is probably one of the things that I've come across more than any other question, not just on VA loans, but across the board. When I'll ask people, as part of the qualification process, where's your down payment funds? Or in this case, if you're not having a down payment, where are your funds to cover for closing costs? And my favorite answer, said sarcastically, is, "Oh, I can come up with it." And then, of course, I have to probe a little bit more, and turns out it's mattress money,
Okay. Yeah.
or they have cash. They don't like the bank, don't trust the bank, or whatever the reason. But that money has got to be sourced. So
Okay.
typically, you're going to have the money and show that it's been in the bank, checking, savings, whatnot. And usually they want to see that it's been in there for 60 days. That's kind of the general rule of thumb. And without any large deposits within that time frame, because they also didn't want you to take the mattress money and just throw it into the bank so that you could qualify.
Okay.
So that's basically how it works when it comes to assets.
Okay. So a lender is looking at it as almost like a risk-based thing, right?
Hmm.
Do they have that money? Is it stable? It's
Hmm.
been there a while. So then, if you were to get, let's say, your parents or a spouse's parents or somebody in your family wanted to help you out with money for a down payment, they couldn't just wire it to you a week beforehand and then you have it. So you actually have to have it seasoned there for a while before the lender's going to say, okay, yes, you have the money.
Yes and no. Actually, that can happen when it is then becoming what's called a gift fund.
Okay.
So let's just say the closing costs will throw out a number of, let's say there's $7,000 for the closing costs, and our veteran just doesn't have it and they want to get it from mom and dad. Then it's just a very simple process of a gift letter that basically says, because this is important, it's a gift. It doesn't have to be paid back, because otherwise it would have to count towards their debt ratio.
Okay.
Yeah.
All right. Now, are there any other kind of down payment assistance funds or programs or anything else that a borrower might be able to apply toward the closing cost or the purchase of a home?
Yeah, absolutely. They vary by state, but each state has some that are county, some that are state specific, but you can piggyback a down payment assistance program with a VA loan, even if it's just to cover the closing cost.
Wonderful. Okay. Well, for anybody who's listening or watching out there, be sure to talk to your lender. They might know, or your real your broker or real estate agent.
Hmm.
They might know about these programs. Also, check with your veteran service office. Most counties are going to have something, so you can check with them and see if they're aware of any programs that are local to you. Okay, let's talk about income and employment because just having a little bit of assets is okay. I've got $20,000 in the bank, and that's going to cover my closing costs. And I got a little extra, so the bank feels good about it. But I need to show them that 20,000 is not all that I have, right? I still have income coming in, right? So,
Hmm.
what is a lender going to look at as far as income and employment go?
Well, and it's a good question because I'll even take and expand on that. Sometimes I will have buyers that actually they 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 have, let's just say they have $100,000 in the bank,
Hmm.
and they're not going to put anything down, but they have $100,000 in the bank, and they think, well, yeah, but I have all this money. And I've actually had buyers that have enough money to pay for the house in cash, but they don't want to. And understandably so, I don't recommend that. And then they think, well, because I have the money, I shouldn't have to prove my income. You always have to prove your income because it's that money could be gone tomorrow because they could
Yeah.
liquidate it. So they still have to have, generally, especially for a VA loan, they have to have a 2-year work history. And that doesn't necessarily have to be W-2'd, but it does need to have a 2-year steady work history.
Okay. Now, let's say I'm married. Now, other buyers might not be, but in this case, I'm married. I have got a spouse. Maybe she works as well, and the lender's probably going to want to see both of our sources of income, right? Uh,
If she's going to be on the loan or he's going to be
yeah.
on the loan,
Yeah.
then yes. Mhm.
Okay, that makes perfect sense to me.
Yeah.
So, okay, now I'm a little different. I'm self-employed,
Mhm.
so I know if you're self-employed, if you're in the military, like you've got a W-2, you have your LES that's going to show
LAS.
your income, and the lender's going to take that. But let's say you have a spouse who's self-employed, or you leave military service like I did, and then I became self-employed. That's a little bit different.
Mhm.
So for me, I decided to pay myself a paycheck with a W-2. So
Mhm.
I had that, but the lender still wanted to see a little bit extra.
Mhm.
I think they went back an extra year or two, even with my W-2s because I'm self-employed, and they wanted to see that. But some people might not have those W-2s. So are there any recommendations for self-employed or sole proprietors or anything like that so they can prove their income?
It all comes down to what it is that you show. Because
Right.
when I work with folks that are self-employed, independent contractor, freelance work, whatever it is, but they're 1099, they will tell me how much money they make,
Mhm.
but it doesn't show on their tax returns because, well, I mean, let's face it, you don't want to pay Uncle Sam everything.
Yeah.
So what they'll do is they'll write a lot of things off. So all of these things tie into the reason why, if you're self-employed, you're going to have to show 2 years of tax returns that were filed and received from the IRS. That is what they're going to look at, and then they're going to average that out. And they're also going to see if, let's just say you had a great first year, but you didn't have such a great second year. That could be an issue. So these are things to think about,
Yeah.
especially if you're just newly self-employed, that, you may want to write everything off and take as much of a loss as you can so you can keep your money, but you got to be careful with that because you're still going to have to be able to qualify based on those 2 years.
Yes, great advice. Definitely something to worth looking into if you are self-employed or a spouse is self-employed and you want to use your spouse's income toward qualifying for your mortgage. Okay, so uh, are there anything people need to be aware of about, let's say, job history? Let's say you're bouncing around, you got out of the military, maybe you took this job, found it wasn't right for you, or you got a better job offer. Does job history count toward buying that house or getting that loan? What are your thoughts there?
Sure.
What are your experiences there? More
Right,
importantly,
right.
yeah.
So, I mentioned earlier, as far as VA underwriters tend to be almost more common sense
Hmm.
approach underwriting, and same rules apply. So, ideally, you're going to have the same 2 years, same job, and consistent income, maybe even a consistent position, or if anything, you're going to maybe have gotten a raise and a
Yeah.
promotion. Those were the days of our parents and our grandparents more than they are today. A lot of times people are just, they're still taking different jobs and they're moving from one company to the next. There may be a time where they were unemployed for a few months. VA doesn't have hard and fast guidelines that says if you have a 3-month gap, you're not going to qualify. But what's most important about it is if you can, even if you're changing jobs, is to have a similar line of work and be able to show a 2-year history with limited gaps. Doesn't disqualify you if you have gaps, but when you get past 3 months, they're going to look a little bit harder. And that's where other things are going to come into play, like your credit score, your debt to income ratio, and things like that.
Okay, great advice. Now, speaking of debt to income ratio, let's talk about that a little bit. Um, what is involved with a debt to income ratio? How is it calculated? And what can home buyers do to prepare for buying a loan, or what can they do to make their situation more favorable?
Sure. So first, the way the debt to income ratios are calculated very simply. You've got two of them. You've got what's called a front end and you've got what's called a back end. The front end ratio is just your housing expenses. Everything, not just your mortgage payment, but also if you have an HOA, your property taxes, your homeowner's insurance. So all of those divided into your income on a monthly basis, that's your front end ratio. Your back end ratio then ties all your other debts that show up on your credit report, such as your car payment, credit cards, student loans, etc. Then the kind of sweet spot, even though, once again, the VA does not, it's another one of those areas, they do not set any number as far as what you have to be at in order to qualify. However, 41 is kind of the sweet spot, 41%. And when you cross over 41% and you have a higher debt to income ratio than that, then they start looking at what's called residual income. They want to make sure that you have enough to cover things that aren't on your credit report, like food, utilities, gas, clothing, and residual income then gets calculated in according to how many family members that you have. So, so there's a kind of a
Okay.
fine line there that you want to try to find that balance. But I've actually gotten people approved at up to 70% debt to income ratio. I'm not saying it was necessarily a good idea because that's how much income, that actually is
Yeah.
going towards that. But it goes to show that, again, VA loans and VA underwriting, it's a lot more flexible and case by case.
Okay. So, in terms of your debt to income ratio, we said 41% is kind of that sweet spot where they start looking at the numbers a little
Mhm.
more closely.
Mhm.
So, if I've got a 25% debt to income ratio, lender's going to look at me and say, okay, you're in a green zone, more or
Mhm.
less, right? You're
Yeah.
pretty favorable. Now, let's say I'm at or above that 41%. What are some things that I can do to start planning to get my debt to income ratio lower so that it's more favorable for a loan?
Sure.
What are some actions I can take?
Sure. Well, one of the easiest things to do, if it applies to you, is if you have an installment loan. So, credit cards are revolving accounts, and installments are things like your cars or personal loans and so forth. If you have an installment loan that is, you owe more than 10 payments on that, you don't have to actually pay that off. You can pay it down to a balance that is equal to 10 payments or less. And then that payment is no longer counted against your debt ratio. So there's little
Okay.
tricks of the trade that you can do. And there are exceptions to that. It's not a across the board 10 payments or less on an installment loan. They're going to look at it and still make sure that you're not too high of a risk. But things like paying down credit cards will not only boost your credit score, but it'll lower your debt ratio, or paying down an installment loan to 10 loans or less. Those are all things that are going to help you when it comes to qualifying.
Awesome. Well, thanks so much. Is there anything you want to add on qualifying in terms of more of the financials when we're talking about our credit score, the assets, the cash we have on hand, debt to income ratio? Is there anything else that veterans or the military community need to be aware of when it comes to qualifying for these loans?
Yeah, I would just say to really prepare yourself, just go into this with there's basically four things. You're going to need a certain credit score.
Mhm.
You're going to need a certain debt ratio. And these are all things that you can literally jump online and you can play around with a mortgage calculator and figure these things out. Even though you're not going to need a down payment, you're most likely going to have to cover some or all closing costs. So get a determination of what that is going to be. Make sure that is not hidden in your freezer or your coffee can or wherever. Have that in the bank, and 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 then the rest is just the job history. So if you're thinking about, because I've had this happen before, where somebody decides, you know what, I've always wanted to work for myself, and right before they're going to buy the house, they go self-employed, and they just didn't know any better,
Sure.
and now they're going to have to wait 2 years. or go get another W-2 job. So those are the main things to keep in mind when you're qualifying for any loan, but definitely a VA loan.
Well, thanks for those tips. There's one thing I'd like to add. Uh, just because you qualify again, it's also good if you're moving into a new home to have a little extra cash because there's always going to be a slew of unexpected expenses. You're going to want to paint things, or you're going to need new furniture, or you got to do some landscaping. So, whatever your down payment expenses you expect them to be, boost that a little bit and have a little extra cash just in case, because moving into a new house can have some unexpected costs. But
Couldn't agree more.
yeah, great tips. These are all super valuable. Thanks so much for sharing them.
Absolutely.